In this module, we shall study about the technical analysis. In any stock market, an investor does a number of analysis before buying a stock. Sometimes they hire professionals to guide them and analysis about which stock to be bought and sold. Among various methods of analyzing stock, one is technical analysis. Technical analysis is concerned with the study of the past price behavior of shares as well as volume of shares being traded in the past. One can study daily or weekly price and volume data of index comprising several stocks like Sensex or Nifty. A method of valuing securities by considering data produced by market movement such as past prices and volume. Technical analysis do not attempt to measure a security's intrinsic value, but instead use charts and other tools to identify patterns that can suggest future activity. Analysts who are using technical analysis believe that the historical performance of stocks and markets are indicators of future performance. Technical analysis is all about studying stock price graphs and a few momentum oscillators derived thereof. It must be understood that technical studies are based entirely on prices and do not include balance sheet, profit and loss accounts fundamental analysis. In technical analysis, it is being assumed that the markets are totally efficient and all the possible price sensitive information regarding a stock or shares are built into the graph of price of the concerned security or index. Therefore, technical analysis supports the efficient market theory as against the random walk theory, which supports the belief that stocks can be bought, sold on random events. Technical analysis is not dependent on corporate events like quarterly results and special announcements like earnings guidance and policy changes in operations to generate a buy-sell recommendation. After studying this module, you shall be able to understand the concept of depository, know why do we need depository, understand how depository system works, comprehend the need of Depositories Act 1996, understand about NSDL and CDSL. Let us understand the principles of technical analysis. It is generally recognized that there are three basic principles of technical analysis. The three principles are as follows. Market discounts everything. The market exhibits trends. History repeats itself. First, market discounts everything. The first is that the action of the market reflects everything. This is extremely important because underpinning technical analysis is the concept that just by studying market action, we can get a good idea of future movements. There are many things that can affect the price. These include fundamental factors such as how fine products are selling and what profit margin can be achieved. Political or corporate factors such as legislation, the putting in place of a new CEO or changes in working practices. Psychological factors such as whether the latest garment will attract the attention of people or not, or the BlackBerry becomes a must-have for business reasons. By cutting across this and declaring that all these factors which may or may not be knowable become included in the price by market action. The technical analyst can focus on the market alone and does not need a squad of research assistants. In technical analysis, it is believed that all the above factors are incorporated in the prices of the securities. If a person has positive attitude towards a security, then there will be an increase in the demand of that security. On the other hand, if there is a negative attitude of people regarding a security, then there will be a fall in the demand for buying that share and increase in selling of such shares. In economics, we have already studied that the supply and demand for any product, set its price. If demand is more than the supply, then in time the price for a commodity will rise. If this happens for a share, that is, prices of shares are increasing, then we call it a bullish market. On the other hand, if demand for share is less than the supply, then there will be a fall in the prices of such shares. The market for such shares is called as bearish market. Thus, a technical analyst focuses only on the prices of security, as every information regarding demand or supply of share is reflected in the prices of the security. Thus, there is no need to focus on various factors like financial results, political situation, trends for a particular product of a company, seasonal factors, etc. Only studying of trends in the movement of prices will give a good idea about them. Second, the market exhibits trends. The second principle of technical analysis is that the prices of securities tend to move in trends. By this we mean that if the price is rising, then it will in all likelihood continue to rise, and when falling, then it will keep going down, and when hovering at about the same level, it will keep doing that. This sometimes is known as moving sideways. Of course, none of these things go on forever, but it is generally predictable that a trend will go on for a though in the past changing. A lot of trading plans are based on this basis that let the trend be your friend, which means you should trade to follow the existing trend. It is assumed that if you are not following or going with a particular trend, then it might expose you to more risk than you could have been to. When trading with the trend, your task reduces to identifying the trend as soon as possible, so that you can enter the trade early and keep on with it while waiting for until it shows signs of failing or reversing. Many traders try to capture the greatest gain as much they can while being confident enough that what they have identified is a real trend. Third, history repeats itself. The third principle of technical analysis is merely a statement that we don't expect people to change their behavior. In other words, we put our faith in on the fact that history being repeating itself, with patterns and actions that have happened in the past leading to the same results when they happen in the future. George Hegel once said cynically that we learn from history that we do not learn from history. The task of the technical analyst is to learn what history has to teach. The psychology of traders and investors has not changed over decades, but this fact can be used to give advantage in the technical analysis. It is believed that traders' mentality remains same. Therefore, they behave in the same manner in similar situations as they did in the past. So, if one can understand that how a person behaves, then he can make gains in this market by analyzing the trends. This again is a central belief to trading using technical analysis. We rely on a study of history to tell us what normally happens in a certain set of circumstances, and then we expect that the same thing will happen again. The outcomes are seldom or never sure, but trading is a percentage game. We stack the odds in our good turn and then use wise money management to make sure that the end result is a fully clad profit. Next is tools of technical analysis. A technical analyst has and uses following tools for doing technical analysis. These tools are charting and market indicators. Here we will discuss in detail about charting. Charting is one of the crucial activity in technical analysis. Till now, we have understood that basic motive in technical analysis is to identify the price trend. This trend is to be found by studying the past data about the price behavior of a stock. And such past data helps to predict the future behavior of stock. Thus, the inputs for technical analysis is the price and volume data. Charts and graphs are the basic tools that are used in identifying the current trend in prices. These charts or graph can be drawn either for a specific share or for the market as a whole. If one is concerned with the specific share, then he is required to study the data for that particular share. And in case he is doing the analysis of the market, then he will look for the past behavior of that market or an index. Since in charting we are concerned with finding out price trends, therefore one should know what prices he has to look for. A security is traded at different price levels on any particular day. Out of these different price quotations, 4 prices are relevant and important. These prices are as follows: opening price, closing price, high price and low price. Opening price. As the stock exchange opens on a day, the first price at which the trade of a security takes place is called the opening price of the security. A security's opening price is an important indicator for that day's trading activity, especially for those interested in measuring short-term results such as day traders. Closing price. Closing price is the last price at which the security was traded on a particular day before the stock market closes for that day. The closing price signifies the most up-to-date estimate of a security up to trading starts again on the next trading day. Closing prices make available a useful marker for investors to measure changes in stock prices over time. The closing price of one day can be compared to the previous closing price in order to measure market sentiment for a given security over a trading day. Stock indices for a day are also calculated on the basis of closing price of the constituent security. Low price. It is the lowest or the minimum price at which a particular stock was traded on a day. High price. It is the highest or maximum price at which a particular share was traded on a day. Now, before starting to understand different types of charts, it is first required to know about the two theories that tells about how the trends can be shown in a chart. These two theories are as follows: Dow Theory and Elliott Wave Theory. We shall now discuss the Dow Theory. The legend of technical analysis, Charles Dow, is the father of what is popularly known as the Dow Theory. Though developed more than a century ago, his theory is used even today by analysts to evaluate market behavior. The Dow Theory was developed to analyze the movement of indices and was based on the closing price of the indices. Assumptions. The three assumptions underlying the Dow Theory are: first, the primary trend of the price movement cannot be influenced by external factors. Second, the market discounts everything. Third, the theory is not foolproof. Trends. The Dow Theory explains that there are three types of trends applicable in a market. These trends are known as primary trends, intermediate trends and short-term trends. Primary trends. Primary trend is the long-term direction in the price movement and lasts for a year or a number of years. It also consists of three phases, wherein each phase is interrupted by an intermediate trend reversal lasting up to 2 to 3 weeks. This intermediate trend takes away the earlier price movements upward or downward. Secondary trend. This trend appears within the primary trend and may last for a period ranging from few days to weeks or months. These trends indicate interruptions in the primary trend and act as a preventive force on the primary trend. Minor trend. Short-term trends are also known as minor trends and can be witnessed intraday or during a few days. These trends correct the overbought and oversold positions in the script caused by reversals made in the secondary trends. For the purpose of analysis, it makes sense to ignore short-term trends and analysis the primary and secondary trends in prices. Now, moving on to the Elliott Wave Theory. This theory was given by Ralph Nelson Elliott. He observed that the ever-changing path of stock market prices reveals a structural design that in turn reflects a basic harmony found in nature. From this discovery, he developed a rational system of market analysis. He gave the wave principle. He gave the principle of studying the market on the basis of the 5-wave pattern. In markets, progress ultimately takes the form of 5 waves of a specific structure. Both Dow theory and Elliott wave theory are important to understand trends. But there are some other types of charts. Some of them are as follows. Bar chart. A bar chart is used by some technical analysts on which, as illustrated below, the top of the vertical line shows the highest price for which a security was traded at during the day, and the bottom of this line represents the lowest price. The closing price is displayed on the right side of the bar and the opening price is shown on the left side of the bar. Each bar has 4 basic elements: open, high, low, close. That's why it is also called as OHLC bar. Now let us discuss the line chart. A line chart that is created by connecting a series of data points together with a line. This is the simplest kind of chart used in finance, and it is usually formed by joining a chain of previous prices together with a line. A line chart is usually created by taking closing prices for companies' share on different days. A line chart can give the reader a fairly good idea of where the price of an asset has travelled over a given time frame. We shall now discuss the candlestick chart. A candlestick chart have a data set that contains open, high, low and close values for each time period one wants to display. The hollow or filled portion of the candlestick is called the body, also referred to as the real body. The long, thin lines above and below the body represent the high, low range and are called shadows, also referred to as wicks and tails. The high is marked by the top of the upper shadow and the low by the bottom of the lower shadow. If the stock closes higher than its opening price, a hollow candlestick is drawn with the bottom of the body representing the opening price and the top of the body representing the closing price. If the stock closes lower than its opening price, a filled candlestick is drawn with the top of the body representing the opening price and the bottom of the body representing the closing price. Next, point and figure chart. A point and figure chart plots day-to-day price movements without taking into consideration the passage of time. Point and figure charts are composed of a number of columns that either consist of a series of stacked X or O's. A column of X is used to illustrate a rising price, while O's represent a falling price. One can study the pattern of movement and can do analysis regarding the price behavior. Let us now recapitulate what we have learned so far. Share prices are one of the important indicators of various factors that affect a company's performance. One can understand the price behavior of a particular stock is actually displaying how the demand and supply for a stock is changing due to several factors. Thus, technical analysis focuses on the study of such price behavior. A technical analyst uses this information regarding price behavior and its pattern to know how the share, its price and volume will behave in future. For such an analysis, he uses various kinds of charts and pattern analysis as well as indicator analysis. In the next chapter, we will study about pattern analysis and indicator analysis.